Good afternoon. My name is Amit Singh, and in this class of Indian economy, today we are covering the topic deficit. Now, this topic is more the continuation of the chapter what we have started in the last class, that is fiscal policy, which is commonly known as budgetary policy or budget. Okay. Now, before getting into this topic of deficit, I just give you a little recap what we had covered as per the components of budgets are concerned. The reason behind this is because this topic is more linked with the components of budget. We are covering the deficit part. It is more having the linkage with the budget. So if you don't have a little idea about the budget, it's quite difficult to understand this topic, though it is very important as per the UPSC civil service exam is concerned. Okay, so I'll give you a little gist about the components of budget. Components of budget. So we have seen that this budget is all about the receipts and, or you can say total receipts and total expenditure of the government, which the government is going to make in the coming financial year. Okay, so two primary heads are the receipts, so how the money is going to come into the pockets or the accounts of the government, and how the government is going to utilize this particular amount in the coming financial year is actually forms under this, or what we study under this budget. So under this total receipt, we're having two sub components. Okay, that is revenue receipts, and second one is capital receipts. In the same way, we're having the division of total expenditure as revenue expenditure, and the second one is the capital expenditure. We know the meaning of expenditure and of course the receipt, but they were having two new concept, that is revenue and capital. In both these heads, receipts and the expenditure. So how can we differentiate revenue and capital? Okay, so there the difference between these two we can test with the help of two things, that is assets and liabilities. Okay, so in detailed we had covered in the last class or last video, the video of fiscal deficit, what we had covered earlier. So in case of revenue, so if the government is receiving the money by selling or by taking the loan, in that case that all comes under the category of capital account, capital receipt. So government is receiving the money either by selling the assets or by taking the loans or by having more liabilities, of course. In that case, we put all the receiving under the capital account. If it is not so, okay, if it is not having any influence over the assets and liabilities of the government, or the government is having the money in their account in the form of earnings, in that case it will be taken up as the revenue receipts. Okay, so there we count the earning which is having no influence, no effect. This is the litmus paper test, you can say, whether it forms a part of revenue or the capital account. No effects over assets or liabilities of the government. In that case, we put the receivings of the government under the account of revenue receipt. And if it is not so, it is having influence over the assets and liabilities of the government, we take it as the capital receipts. Effect over assets or liabilities of the government, in that case we take it as all the receivings under the account capital receipts. Okay, in the same way, if you go with the case of expenditure, okay, if the money is been spent, expenditure is all about the spending of the government. Okay, so if the money is being spent without having any influence over the assets and liabilities of the government, in that case we take it as revenue expenditure. That means the government is spending the money for operating the departments, for managing the, for running the government, without purchasing the assets or decreasing the loans what they have taken earlier. If that is so, so we take it as it is a revenue expenditure. No influence, no effect over assets or liabilities of the government. Okay, so it is having effect over assets or liabilities of the government, right? So that is how we check out whether the receiving or the expenditure is coming under the account of capital or revenue. It is depending over the influence over the governments or the country's assets or liabilities. If the assets are increasing, if the government is spending money and assets are increasing, so that amount will become under the capital expenditure. And if there is decrease in the liabilities or the loan, it forms a again forms a part of capital expenditure. If that is not so, if the government is simply spending money just to run the government, just to run the departments or managing the schemes, in that case all that money forms a part of revenue expenditure. Done? Okay. So this is the basics which should be known before moving into the chapter or the topic deficit. So I'll just move back uh, into today's topic, deficits. Okay, so what is deficit in fact? So deficits can be defined in the way of gap between the income and expenditure of the government. It can be of government, company, trading, or you can say even the management of the finance of an individual also. So there is a gap between the expenditure, the spending what the government is making, and of course the earning of the government. If that is so, then that gap can be termed as deficit. That means there the income or the revenue of the government is less than the total expenditure. Okay, total expenditure is more, spending is more than the income. Okay, right? Now there is one golden rule, in the economics, that we should not we should not go for the borrowing for our self consumption. Okay, so we should not borrow the money for the self consumption, applied to everybody, whether it is an individual, company, or it is the case of any government. We should not borrow money for the purpose of self consumption. So there in this case what is happening, that the government is bound to borrow money for the self consumption. Okay, because the income is less than the expenditure. That means how the expenditure will be fulfilled, it is only by borrowing the money. Okay, so that is how this gap in fact this gap or the deficit talks about what the government is going to borrow in the coming financial year. Okay, that is the deficit. Now on the basis of this gap between revenue and the expenditure, okay, we can have different types of budget based over the deficit budgets based on the gap between income and expenditure, or you can say it is more better to say revenue or receipts. Okay, right? So there in case of receipt we are talking about non-debt receipts, which is not creating any kind of borrowing or loans. So those receipts and income, if there is receipts and expenditure is having gap, on the basis of that we are defining the budget, which can be of three types. One is we are having surplus budget, right? Second, we are having balanced budget. So either the government will go for the surplus or balanced budgeting. And the third case what we're having, third type what we're having is of course the deficit budget. Deficit budget. So what happened? Though the first two looks more the idealistic budgets, of course, we're having surplus budget. We do have the balance budget. In case of surplus, there the income, there the revenue is or the income is more than the total expenditure. Now, in this case, the government is able to save something. There, the income is more and the expenditure is less. Suppose I'll go with the example expenditure is around 1 lakh. If you go with the simple example, 1 lakh, and the revenue what the government has earned in the coming or going to earn in the coming financial year is around 1,20,000. Suppose, okay, in that case, they were having surplus of rupees 20,000, right? Okay, so this 20,000 is the surplus. That is how this kind of budgeting, that means this kind of management of financial is showing the surplus, and the budget is called a surplus budget. Then, but what happened? Most of the case, the developing countries like India never go for this kind of surplus budget. The reason is because here the aspirations of the public, the money of which they are dealing with, okay, aspirations of the public are more, okay, and the sources or the funds are less, okay. And if that is so, if we are having lesser fund compared to the aspiration or demand of the public, and still we are able to save the money, that means that shows that the government is not working properly, or this government might be the incompetent government. Even after giving them money, they are not able to spend properly to meet out the requirement of the public. So this shows that the government is more incompetent, okay. So that is why most of the government never go for the surplus budget, okay. Second one is the balance one, okay. That is the balanced budget. That means the earning or the spending is equal to the earning, okay. So jitni chadar utne hi pair pasarna, okay. So there we are having the equal revenue. 1 lakh is the revenue or the income, and same is the case with the save and this expenditure also, okay. They were having 1 lakh expenditure, okay. So there the government is planning in such a way that they are simply matching the expenditure with the amount they're going to earn in the coming financial year. If that is so, then this kind of planning can be termed as balanced budgeting or balanced budget, okay. But again, since we are having a number of sources which provide us more cheaper money supply we can have. So why not we take the advantage of these all sources, take the cheaper money for long term time period, use it for the purpose of investment, invest the money, earn from that particular venture or the investment, and pay back the money, okay, right? So there we are having a number of sources like World Bank, IMF. So there we're having a number of economies are there like South Korea, Japan. They can give us money in a very cheaper rate of interest like 1% or 2% per annum, not in fact per month. So there the rate is very less, and that too for long time period. Of course, we're having time period of around 30 years, 40 years. So why not we borrow money from there, just make a little higher expenditure, okay, in which we also count the expenditure for the investment or the capex we are talking about, okay. So we can have more little higher capex over here. We take the money from these all sources providing very cheaper money, okay, that is for longer time period. We can borrow money from those all sources, invest in the market, create more employment, also increase the growth rate, okay. And from that investment we will earn money and pay off the money what we have borrowed from various sources, like I've told you, like we're having Japan, South Korea, IMF. This all borrows money at a lesser cheaper rate of interest. So because of that, most of the case the government usually don't go for the balanced budget, but make a little rise of increase of the expenditure compared to the income, and go for the third category of budget, that is a deficit budget, okay. So now we move into the third category, that is the deficit budget, okay. So there of course you can able to understand now that there the revenue or the total non loan creating, debt creating, there the B is silent over here, debt receipts or the revenue receipts are less than the total spending or the expenditure of the government for the coming financial year. If that is so, then the budget will be put should be put under the category of deficit budget. Okay, right? So they were having the gap between the income and the expenditure, or the you can say negative gap between the income and the expenditure. So there the expenditure is more compared to the income or the receipt what the government is going to have for the coming financial year. In that case, this budget is called as deficit budget. So what this is all what we are covering over here. So there we see that the receipts are less comparatively, and there the expenditures are more. Okay, right? So this kind of budget we are having. We go further. Now deficit shows some kind of imbalances what we're having in our financial. Okay, if there is a gap, of course this gap going to be fulfilled by the government or a company or even individual by borrowing money from various sources. Right? And I've told you borrowing for the purpose of investment for in the form of capital expenditure or capex is okay. Okay, but that too up to a limit. So for capex is okay, but for the purpose of revenue expenditure, for the purpose of operational expenditure, or for self consumption is of course not good for any economy. Okay, that is what we are going to see, what we have to realize when we cover all these topics like deficit. Okay, so now we go with a certain type of deficit what we see in our budget. Okay, when the government presents the budget also provide how the different types of deficit and the numbers linked with those all deficits, so that we can analyze that what kind of imbalances we may have in the coming financial year. Okay, so now we go with the types of deficit. So most of the cases government present the deficit budget. If you go with the example of the budget, the first budget of Free India, I think that time also we're having a deficit of around 26 crore approximately. This is approx number, of course. So first budget of Free India was almost having the deficit of 26 crore. Okay, the reason is of course very obvious. The reason is they were having more higher aspirations, of course, more higher needs of the people of the country as compared to income. Okay, so it was bound to have more higher spending, bound to have deficit over there. So right from the first budget of Free India we're having the deficit budget. In case of types of budget we cover this part. Okay, usually we can see four types of deficit in our budget. First one is we are having revenue deficit. Second is again it's more a statistical construct. Second one, if you go with the second one, that is effective revenue deficit. Okay, so which was introduced in the year 2011. The time when we were actually witnessing a number of crises, like subprime crisis were there, sovereign debt crisis were there. So that time the government bound to come this kind of statistical construct in the form of effective revenue deficit, so that they can show some kind of lesser number to save themselves from the hue and cry of the public. Okay, third one is we're having fiscal deficit. Okay, fourth is primary deficit, and there is one more deficit which is called as monetized. But this monetized deficit, this type we are no more using. Okay, so we have stopped using monetized deficit since 1997. Okay, though in case of FRBM Act it has certain clauses, we are having certain escape clauses where they can come up and go for the monetized deficit if there is very urgent condition situation where they are bound to go for the printing of currency. Okay, So these are the four which are important to us, which are usually been seen when we talk about the budget, okay, are usually been calculated by the government only, but not the fifth one. So there in this case, we have stopped calculating this particular monetized deficit since 1997. So we deal with this all four one by one, even fifth one also, I'll deal with this also. So I'll go with the first one. First one is revenue deficit. So just to understand this, I just move back to my flow chart, what I have drawn for dealing with the budget, okay, right? So this is the component of budget, and in this we have seen that we're having receipt and expenditure, and which is also having subdivision in the form of revenue receipt, capital receipt, revenue expenditure, and a capital expenditure, right? Okay. So now in case of revenue receipt, we deal with these two parts, revenue receipts and revenue expenditure. We have to deal with the revenue account over here, which is talking about revenue receipt and revenue expenditure. Okay, revenue, I've already made, if the money which is coming or going out is dealing with their day-to-day expenditure, okay, which is not having any expenditure or the income, of course, which is not having any influence over the assets or liabilities of the government. In that case, we'll put these all expenditure or the receipt under the account of revenue. Okay, so in case of revenue deficit, I'll go here itself, revenue deficit. If revenue expenditure is more than revenue receipt, in that case the condition develops over here is revenue deficit. Okay, so if the revenue expenditure is more than the revenue receipt, then the condition over here is called as revenue deficit. Okay, right? Now I'll just show you with the help of one example also. Now suppose if we go with the current example for 2026-27, okay, so there the revenue expenditure is somewhat near to 35 lakh crore. Sorry, it is 41 lakh crore. Okay, and in case of revenue receipt, it is somewhere near to 35 lakh crore. Okay, so in this case, what is happening? Okay, there the revenue expenditure is more, around 41 lakh crore, and the same way revenue receipt is 35 lakh crore. So over here we're having the deficit or the gap of almost around 6 lakh crore. Okay, so for the coming financial year, for the current budget for 2026-27, they were having the revenue deficit which is around 6 lakh crore, or approximately somewhere near to 5.92 lakh crore. Okay, number is somewhere near to 6 lakh crore. Okay, so this is almost equal to 1.5% of GDP. Okay, so what the government has planned, it has planned that to limit the number up to 1.5% of GDP. Even if you go with the number of 2025-26, there also the government targeted or revised to 1.5% only. Still we are maintaining the same number of 1.5% of GDP. This is what we can expect to have revenue deficit, what we have to manage. Okay, now as per the golden rule, it has been said that we should not have revenue deficit, or this revenue deficit should be bring down to zero. It should be zero. It should not be uh, not towards, it is not towards the we can say not favoring the spending part, of course. Over there we should not have the revenue deficit, it should be bring down to zero. That means we should have in fact lesser spending in terms of the revenue expenditure. Okay, uh, as compared to the earning of the government. This shows that the government is unable to meet out its own day-to-day expenditure with their earning, which should not be there. That means for an individual, the income is lesser than the spending. Okay, so there the income is, suppose we are having 1 lakh. Okay, and the spending is or the expenditure of the month is, suppose 1.2 lakh. In that case there the revenue deficit is of course around 20,000. So it has been said that it is good to have the revenue deficit to zero. Okay, it should be bring down to zero, and if possible, it should the government should strive to get into revenue surplus. Go for revenue surplus. That means government should work in such a way that first of all it should bring down to 0% or zero, of course, and thereafter it moves in such a way that it should move towards the revenue surplus. Okay, or the government should start saving something from this revenue account. Okay, first of all it need to spend only that amount what they are having in the form of earning. Okay, and second thing is it also move towards the revenue surplus and start saving something from the earning itself. Okay, so otherwise what will happen, there the government will borrow money. Otherwise, suppose if there is revenue deficit, if it is continuous for more longer period of time, in that case the government is now uh, you can say is now bound to borrow money for the purpose of self consumption. Okay, so which is not good for the economy. It should not be there. It should borrow money on the only on the for the purpose of creation of assets or decreasing of liabilities, but not for the purpose of self consumption. So it is not good for us. So according to FRBM Act, it was said that it should bring down to zero first. Okay, and thereafter we should go for the revenue surplus. Okay, but what happened, this act came into being in the year 2003. Okay, and the target was set for around 2009. It required to bring down to zero, but what happened since 2007 8. Okay, throughout the world we are witnessing a number of crisis condition. Okay, right, so like in 2007-8 we had witnessed subprime crisis, and thereafter 2011 we're having we had witnessed uh, the sovereign debt crisis, which again this all forms the global crisis, of course. Okay, thereafter in India also we are having a number of recessions over here, like in 2016-17 we're having demonetization, and thereafter 17-18 we're having 18-19. Okay, till these 3 years we had witnessed recession in number of sectors like automobiles. Okay, so they were having recessions in number of sectors. Because of that, the earning of the government is having some huge impact. Along with that, when there is a recession, so there the government is bound to increase its expenditure, revenue expenditure, whereas it is also having some negative impact over the earning, which increases the gap. And that is how till date the government is unable to fulfill the requirement or the target of FRBM Act. Okay, this is an act, of course, it's an act which is creating obligation over the government, but we do have a number of escape clauses also, where the government can go for this kind of gaps, of course, if the condition is more necessary. Okay, and of course after 19, you know that in 2020 21, there the whole world has witnessed a major crisis condition, that is the COVID-19. Okay, and thereafter also we don't have a more after dealing with this crisis also we are not in a good condition, of course. There since 2022 we are witnessing a number of geopolitical issues, like we're having Ukraine Russia war, and now we're having the issue which is created between Israel, Iran and America. Okay, so these all issues, this kind of geopolitical conditions actually having some huge impact over the working of the economy of our country. So that is how till date the government is unable to meet out the target which was earlier been given under FRBM Act. Even In 2016, 17, okay, in 2016 we're having the creation of a committee. Encasing committee was there, which has given the report in 2017. It was encasing committee. Okay, so even this committee also said that that we should not go in a very fast pace. Of course, we should make more we have to make the target seeing the present condition. Of course, so there he this committee recommended that we have to decrease the revenue deficit by 0.25% every year. Okay, and bring down to 0.8%. Okay, this committee said that there is no need to bring down the revenue deficit to zero. It is good to bring down below 0.8%. If that is so, it is of course manageable to us. Okay, but still, because of these all conditions or the crisis what we had witnessed thereafter, we are having COVID-19 geopolitical issues. We are working even now also. We're having the issue. We're having the globalized issue over there, which is having some kind of imported, in fact, crisis condition which we are dealing with. That is how still we are there around 1.5% and not able to achieve the target of 0.8%, which recommended by NKSing to be achieved by 2023. Okay, so this is all about revenue deficit. Okay, which should not be there. It should be bring down to zero, and if possible the government should strive to go towards the revenue surplus. Now we go with the next part. Next type of deficit is, okay, so we go with the next one, effective revenue deficit. So we had covered revenue deficit. Now we are getting into effective revenue deficit. Now this concept introduced into our budget in the year 2011, though it was not required of course, but just to give some kind of smaller numbers of the deficit, because we know that this deficit is not good for any economy, for us, for our economy. So they are just to have more lesser number. Statistically what we have done, just to save themselves, the government has come up with this concept called as effective revenue deficit. So what the government has done over there, just to bring down this particular concept, so there I just moved back to the flow chart. Yes. Now see over here, in the revenue expenditure, the expenditure what the government is making to run to go with the working of course, or to have the proper running of the government. Okay, so there we are having revenue expenditure which is not having any influence over the assets and liability of the government. In this we are having a part called as grants, grant in aids or grants. Okay, so grants are the unidirectional payment which is not creating any kind of obligation to pay back. Okay, right? So if somebody has received the grant, the receiver is not required to pay this grant back. Okay, so that is the in fact we're having this grant, or we're having the unidirectional payment. Okay, so most of the case what happen, the central government provides the grants to the state government, right? Okay, so this grant which has been given to the state government can be utilized in two ways. Okay, right, I've told you already, made you know, this is there just to show the lesser number over there but not having much influence over the working of the economy. Okay, so they were having grant which can be utilized by the state government in two ways. First one is for the creation of assets. Okay, and second one is for other purposes which is not having any impact over the assets or liabilities, for the creation of assets or for other purposes. Now this grant which is given by the central government to the state government, for the central government this grant forms a part of revenue expenditure, because there the central government is not having any impact, the spending is not having any impact over the assets as per when the center is giving to the state government. Okay, but could be possible this amount may be utilized, or a part of it may be utilized for the purpose of creation of assets. And I have told you, if anything is having influence over the creation of assets or having influence over the assets, then it should not be put under the heading of revenue expenditure. Okay, but we have to put under the capital expenditure. So that is what the government is doing over here, just to bring this effective revenue deficit. So there, what is happening there, the government is taking out this grant which is utilized for the purpose of assets, for the creation of asset, from this heading. Okay, or reducing from, just a minute. So there, in case of effective revenue deficit, which should be bring down to 0. Okay, so just to show the lesser number what the government has done, so government has simply reduced the fiscal deficit by the grants given to state government for the creation of assets, right? Okay, so if you go with the current scenario or with the budget of 2026-27, there the revenue deficit is somewhere near to 6 lakh crore. Okay, or the number is somewhere near to 5.92 lakh crore, but I am taking the approx number over here. It is somewhere closer to 6 lakh crore, and the grant which is now been given to the or the what the government has projected in the budget 2026-27, that the state government is having the grant which is going to be utilized for the purpose of asset is somewhere near to 5 lakh crore. Okay, it is almost around 4.92 lakh crore somewhere. Okay, so there the revenue deficit is showing a very big number, 6 lakh crore. That's the gap between the earning and the expenditure made for the running of the government. But there what we have done, we have taken out the grant which is going to be utilized for the purpose of creation of asset, and there the number is somewhere near to 1 lakh crore. So now we're having more smaller number comparatively. So if we compare with this RD to ERD, so there the number is somewhere near to 1 lakh crore. Okay, right? So it is the effective revenue deficit. So from revenue deficit, we have taken out the grant which are being used for the purpose, which is going to be utilized by the state government for the creation of asset. Okay, after deducting that part, we will have the effective revenue deficit. So that is how we have not done something in the economy, either by increasing the increasing the revenue part or decreasing the overall expenditure part. But what we have done with the help of statistics, there we are able to reduce the number to 1 lakh in the form of effective revenue deficit. Now the next one is the fiscal deficit. Fiscal deficit. Okay, so again the same flow chart, we have to check out the same flow chart. See this? Okay, so in this component of budget, we're having receipts and total expenditure. Okay, and thereafter we're having revenue receipt, capital receipts, revenue expenditure, and capital expenditure. Now what we'll do, I just expand this part of capital expenditure. Okay, now this part is also having two divisions over here, we can divide for our understanding. Okay, now first part, so there we are receiving the money. There the government is going to receive the money either by selling the assets or by borrowing money. Okay, right? So by seeing that, what we'll do, just divide this whole capital receipt what the government is going to receive into two parts as non-debt or loan capital receipt. And this is CR, capital receipt, right? Okay. Now if this is non-debt, then the other part, of course, it is now debt creating creating capital receipt, right? So now over there we're having two parts in which we are getting the money, okay? So either by selling the assets or by borrowing money, in fact, okay, right? So they were having two parts over here. We're having non-debt capital receipts. So there we are counting that money which has been there with the government, which is going to be there, move into the accounts of the government, either by selling the assets, sale of assets, or you can say we're having disinvestment. In both the case, we're having influence over the assets, okay? But these capital receipts does not create any kind of repayment obligation. It is not need not to be repay to the from the to the source from where we are receiving the money by selling the assets. So once we have sold off the asset, there we get the money and put into the account, but this money need not to be pay back, okay? Now second one is of course the debt creating capital receipts. So in this we cover all the liability part, all the borrowing part, what the government is going to have. Now while counting the fiscal deficit, what do we have to do in this case? We'll take all the expenditure what the government is going to make, total spending or the total expenditure the government is going to make, along with we deduct from this, we deduct the revenue receipt part plus this non-debt capital receipt part what the government is having. So these two parts which is not creating any kind of repayment obligation we have to add and deduct from the total expenditure, and thereafter what all we left actually forms the fiscal deficit. I'll show over here. So what we have to do, we are talking about fiscal deficit, right? So there in this case we take the total expenditure what the government is going to make, expenditure, okay? So from this we deduct that part which is not creating any kind of repayment obligation or which is not been borrowed from any sources. That is, we cover total, sorry, it is total revenue receipts, no repayment obligation over here because it is the money what the government is having by earning, okay, right? So need not to pay back. So there it also required to add plus non debt capital receipt, right? Okay, suppose there the total expenditure somewhere closer to, I think it is around, if you go with the current year budget, it's around 53 lakh crore, okay? So now total revenue receipt is closer to, I think, 35 lakh crore, plus we're having almost I think non-debt somewhere near to 1 lakh crore, okay? So there in case of fiscal deficit, fiscal deficit, it is somewhere closer to 17 lakh crore, I think it is 36. So yes, 17 lakh crore, okay, fiscal deficit. So number I think somewhat closer to 17 lakh crore, okay, or somewhere closer to 16.95 lakh crore is the number, okay, which is talking about the fiscal deficit, okay? So there what we have done, we have taken total expenditure, deduct what from this we have deducted the revenue receipt plus non-debt capital receipt. Okay, it is that part of the money what the government is going to receive, which is not creating any, which is not going to create any kind of repayment liability or repayment obligation. Okay, which need not to be repay back. So if that is so, it will be counted as we get the number, and this number actually called as fiscal deficit. Now see what is actually happening. Okay, so this is the amount we are short, we are having the shortfall of this much of amount. Okay, so this is the total expenditure what we have to, what the government is required to make. Okay, and this is the total receipt where which is government is going to have. Okay, with the help of the earnings plus by selling the assets. Okay, still if the government is shortfall, they were having the shortfall of around 17 lakh crore. That means this amount required to be borrowed from various sources. Okay, so this shortfall is required to be borrowed from various sources of the government. Okay, so this shows what, this shows nothing but the amount what the government is required to borrow. It is nothing but the borrowing part, borrowing. Okay, so you can say that it is, in case of fiscal deficit, it is nothing but the amount what the government is going to borrow for the coming financial year to meet out the expenditure. Okay, it is the shortfall of money which is required to be borrowed by the government to meet out the coming expenditures. Okay, so this amount, this is actually called as fiscal deficit, which is nothing but the borrowing of the government for the coming time period. So this one is borrowing. So if you go with the budget 2026-27, so the amount is somewhere closer to 17 lakh crore. I go with the next part. Now the last part, or the last, we are having primary deficit, right? So we have seen that we're having fiscal deficit which is somewhere closer to 17 lakh crore. 17 lakh crore, it's a huge amount, okay, which is to be fulfilled by borrowing, by going for the borrowing, of course, from the various sources. So this borrowing is what? It is been borrowed by the government, since it has to be managed by, it has to be you can say pay back the by the public only. So there the money will be paid with the help of taxes being charged over the public. So this forms a part of public debt only. It's a part of public debt which is required to be paid back by the public only. So government is getting the money from where? From the pockets of the public. Okay, right? So this borrowing which is going to be there of around 17 lakh crore is going to be the part of public debt only. Okay, so it's a huge amount. So in that case, the government want to see that what is the actual borrowing we are having if there is no interest payment over there. Okay, so there, in case of public, or in the case of primary deficit, so there the government, or we deduct fiscal deficit part, you have to minus fiscal deficit. So by reducing interest payment from the fiscal deficit, we get the number which is called as primary deficit. Suppose the fiscal deficit, if you go with the budget 2026-27, the fiscal deficit is somewhere near to 17 lakh crore. Okay, so almost the amount which forms a part of interest payment is closer to 14 lakh crore. It's a huge amount which has been paid in the form of interest for the borrowing which has been made by the government in past years, of course. Okay, right? So there, this is the amount which is going to be there as the interest payment. So if we deduct this amount, interest payment amount from fiscal deficit, the number what we receive is somewhere near to 3 lakh crore. Right? Okay. So this amount is actually called as primary deficit. So there we have to check that if there is no interest payment to be paid by the government for the coming financial year, then in that case how much borrowing we require to go for. So that amount is actually called as primary deficit. Okay, right? Suppose if there were no borrowing done in the past years, we were not having any kind of interest payment obligation over here. That is, over here it is 14 lakh. In that case, if this is not so, then we would have borrowed only 3 lakh crore. Okay, so compared to 17, this 3 lakh crore is very lesser amount, almost 1/6 the amount what we are borrowing, what we bound to borrow in the coming financial year. Okay, right? So this fiscal deficit minus interest payment, the number what we get is actually called as primary deficit. I think we have already covered all the important deficit. Okay, so now we are left with the last part, monetized deficit. Okay, so we are no more using this particular thing or the concept since 1997. Okay, so there we are not using this one, but what actually this monetized deficit is. So now we know that how much we have to borrow, lakh crore. Okay, it is 17 lakh crore over here, 1717 lakh crore. This is the amount what we are required to borrow for the coming financial year. Fine. Now this borrowing earlier been done in the form in two ways, of course. Okay, from the market, right? So there the government may go to the public or to other sources, of course, and there the government can go for the market borrowing. Okay, which usually been done by the government. They go for the market borrowings, okay, with the help of a number of bond treasury bills. So there it is being introduced into the market, and from there the government collect the money in the form of borrowings. Okay, or the government can go to RBI and borrow money. Okay, so there in case of RBI, in case of the central bank usually, if the government comes to the central bank and asks for the money in the form of borrowing, so what the government can, this RBI do, it simply print new currency, which has now been totally avoided by the government. I've already made you know, since 1997 the government is no more going to the RBI to borrow money. It is there, of course, the government is having some exception there, the RBI has given some exception to the government. So if there is very necessary to go to RBI, then only the government can have in fact advantage to go to the RBI and ask for printing new currency. But normally there the government does not go to RBI to borrow money. So most of the case the government is utilizing this market borrowing to meet out the expenditure. Okay, so now, if suppose the government goes for this particular automatic borrowing, of course, where this government is going to RBI and asking them to print currency to meet out their expenditure. In that case, this amount which is borrowed from the RBI actually called as monetized deficit. Right, okay. So if the government, the amount which is borrowed by the government from the central bank, from the RBI, that amount is actually called as monetized deficit. Okay. So earlier what used to happen, the government earlier planned that yes, this is amount which is going to be borrowed from the RBI, and for that the RBI may create new currency, right? But the creation of new currency is not good because it is having some huge impact over the economy, negative impact over the economy, because this new currency may come into the market, increase the money supply, and may have the inflationary impact, okay, which is not good for the economy, of course. So there what is happening, if the government goes to RBI and asks for the borrowing, okay, this RBI may create new currency, okay, and this new currency move into the market and monetize the economy. That is how this kind of deficit is called as monetized deficit. Okay, so and the process is called as monetization of economy. So this is the monetized deficit But I have told you the government is no more going to the RBI to borrow money by printing new currency. Okay, it usually borrowing the money from the market itself. Okay, utilizing this particular source the government is having, not this one. So that is how we had covered all the deficit. Okay, we had covered revenue deficit, which should be moved down to zero, and thereafter it should go towards the revenue surplus. Second one is effective revenue deficit. It is not of much advantage, much use in the economy. Third one is we are having fiscal deficit, which talks about how much money required to be borrowed by the government in the coming financial year. The fiscal deficit means what? The amount to be borrowed by the government. And the fourth one is the primary deficit, which is nothing but it talks about the fiscal deficit or the borrowing which is required to be made by the government, amount to be borrowed by the government if there is no interest payment to be made by the government. Okay, so if the government would have not borrowed money in the past years, so then there should be no interest, there would have been no interest liability over the government. Then how much money required to be borrowed if there is no interest payment over there? So fiscal deficit minus interest payment will give you the primary deficit. And the lastly we had covered the monetized deficit, which talks about the money may be borrowed by the government from the RBI by printing new currency. Okay, so these are the five types of deficit what we're having utilized by the government for the purpose of borrowing. Okay, through this only we are able to understand the kind of financial imbalances what the government is having. Okay, or the government is making in their financials, of course. So with this I just